Hello everyone, John AG here. Welcome back to my channel, Aurex. If you haven't yet, subscribe to my channel. In this channel, you will find the real information, real market updates that everyone cannot tell you. So please subscribe to this channel, and I love all of my subscribers for your support. And please, watch this video till the very end because YouTube will not push my videos to more people. We have an immense amount of ground to cover today, and I am adding many critical, timely things related to this topic that you absolutely need to know to protect your family, your dignity, and your financial future. What we are witnessing today, on this 23rd day of May 2026, is not just a passing market fluctuation or a temporary dip in the economic cycle. It is a profound historical reckoning. We are watching the tectonic plates of the global macroeconomic system violently collide. And caught directly in the epicenter of this collision are two ancient, immutable forces of truth: gold and silver. Today, we are going to tear apart the mainstream narrative. We are going to dissect exactly what rising interest rates truly mean for precious metals in a world that has seemingly lost its collective mind. We will break down the sticky inflation data, the geopolitical powder kegs ready to ignite, and the undeniable mathematical truth about your wealth. Listen closely to what I am about to tell you, because this is the secret that Wall Street algorithms and central bankers desperately do not want you to understand. Before we even look at a single chart or quote a single statistic, we must acknowledge the deeply human reality of economics. Economics is not just about abstract numbers flashing red and green on a screen. It is about human time, human energy, and human dignity. Money, in its truest form, is supposed to be a battery. It is a store of your life's energy. When you work a grueling 40-hour week, you are trading your finite time on this earth, time you could be spending with your children, your aging parents, or pursuing your passions, for a medium of exchange. You place your unwavering trust in the fact that this currency will hold its value so you can feed your family, buy a home, and eventually retire with a semblance of peace. But that sacred trust has been weaponized against you. Let us look at the brutal reality of May 2026. Just a few days ago, the U.S. Bureau of Labor Statistics released the April Consumer Price Index data. The headline inflation number came in at 3.8% year over year. But you and I both know that the CPI is a heavily manipulated basket of goods designed to mask the true cost of living. If we look under the hood, energy prices alone skyrocketed by 17.9%. Let the sheer gravity of that number sink in for a moment. Every single time you turn on a light switch, every time you heat your home, every time you fuel your vehicle to drive to work, nearly a fifth of your purchasing power in that sector has been evaporated in just 12 months. For the past year, mainstream analysts promised you that relief was right around the corner. They promised that the Federal Reserve would aggressively cut interest rates, that liquidity would flood the system, that money would become cheap again, and that the suffocating financial pressure would finally ease. But then, cold, hard reality struck. The political landscape shifted dramatically, and the nomination of Kevin Warsh as the chair of the Federal Reserve, a notoriously hawkish figure, sent shockwaves through the bond markets. Almost overnight, the intoxicating dream of aggressive rate cuts completely collapsed. The CME FedWatch tool, which tracks market expectations, is now pricing in zero rate cuts for the remainder of 2026. In fact, the probability models are suggesting a near 50% chance that we see another rate hike before the year is out. The era of free money is officially dead and buried. We are staring down the barrel of higher for longer interest rates. And traditionally, according to every single classical economic textbook written in the last 50 years, this is the exact environment where gold and silver are supposed to die a violent death. But look at the markets. They haven't died. And understanding exactly why they are defying gravity is the ultimate key to surviving the coming decade. Ask yourself this one simple question: why is the smartest money in the world ignoring the textbooks? To understand the sheer magnitude of the paradigm shift we are living through, we need to look at the new mathematics of wealth. Let us talk about real interest rates. In traditional financial mechanics, gold is considered a non-yielding asset. It does not pay a quarterly dividend. It does not pay an annual interest rate. It simply sits there. Therefore, the traditional logic dictates that when central banks raise interest rates, institutional investors will aggressively dump gold and buy government bonds, because bonds pay a guaranteed risk-free yield. In formal economics, the Fisher equation perfectly dictates how these real interest rates are calculated. R equals I minus pi to the power of E, where R represents the real interest rate, I is the nominal interest rate, and pi to the power of E is the expected inflation. Under normal circumstances, when the Fed funds rate is high and bond yields are soaring to levels we haven't witnessed since the dark days of the 2008 Great Financial Crisis, the complex mathematical models used by Wall Street algorithms scream at their managers to sell precious metals. Yet, look at the reality of the price action today. Gold is holding incredibly, stubbornly steady above $4,500 an ounce. Just a few short years ago, the mere suggestion of gold sitting at $4,500 while the Federal Reserve maintained aggressively high interest rates would have had traditional economists laughing you out of the room. When the hawkish Warsh nomination was first announced in January, gold did suffer a violent, knee-jerk 20% correction, plummeting to a temporary floor of $4,400. The perma-bears declared absolute victory. They marched onto financial television and confidently stated that the precious metals bull market was over. But what happened next was nothing short of historic. Gold proved its ultimate, unshakable resilience. It rapidly rebounded, pushing past $5,200 in late February before consolidating back to where we are today at $4,500. It did this because the old rulebook has been thrown into the fire. We are no longer operating in a market driven purely by Western yield curves and algorithmic trading based on the Federal Reserve's dot plot. We are operating in a market driven by raw, global survival. The historical inverse correlation between gold and the strength of the US dollar is violently fracturing before our very eyes. We are seeing a massive structural demand thesis play out in real time. Central banks around the world, specifically in China, Russia, India, and the rapidly expanding BRICS nations, are no longer looking at the yield on a US Treasury bond as a safe haven. They are looking at the relentless weaponization of the US dollar. They are looking at staggering, mathematically unsustainable levels of sovereign debt. Goldman Sachs estimates that central banks are continuing to buy approximately 800 tons of physical gold per year as we move through 2026. You must understand that this is purely inelastic demand. These sovereign entities are not day trading gold options on the COMEX. They are methodically accumulating physical bullion as a Tier 1 reserve asset to protect their national sovereignty and escape the fiat system. This means that if you are a retail investor waiting on the sidelines for gold to crash back down to $2,000 just because interest rates are high, you are fundamentally misunderstanding the geopolitical reality of our time. You are applying the logic of 2019 to the brutal reality of 2026. If gold is the steadfast anchor of the global financial system, silver is the indispensable, wildly explosive engine of the modern world. And right now, sitting in May 2026, silver is arguably the most misunderstood, drastically undervalued, and tightly coiled asset on the entire planet. Today, we see silver struggling around the $74 to $76 mark. Over the past few days, we witnessed the spot price drop from a high of $86 down to $74.96. The mainstream financial media will immediately tell you that this is simply because of the hawkish Federal Reserve. They will confidently explain that because silver is a non-yielding asset, the looming expectation of higher interest rates is crushing its momentum. That is nothing but a dangerous half-truth designed to shake weak hands out of their positions. The paper market is desperately trying to dictate the price, but the physical market is screaming a completely different, terrifying reality. Let us look at the hard, undeniable empirical facts straight from the Silver Institute's World Silver Survey of 2026. We are currently entrenched in our sixth consecutive annual supply deficit. The projected deficit for 2026 alone is a staggering 67 million ounces. Furthermore, the cumulative deficit over the past several years has now reached a mind-bending 762 million ounces. Global mine supply growth is completely anemic, registering at a pathetic 1.5%. The easy silver has already been pulled from the earth. The ore grades are declining globally. Recycling efforts cannot even begin to keep up with the burn rate. And on the demand side, we are witnessing a monumental technological revolution that mathematically cannot happen without physical silver. You cannot build a modern solar panel without silver paste. You cannot construct an electric vehicle without massive amounts of silver for electrical contacts and circuitry. You cannot build advanced medical equipment, 5G infrastructure, or high-end military technology without silver. Just this month, in May 2026, we saw India, one of the largest consumers of precious metals on Earth, resume massive silver bullion imports after a brief month-long suspension. Physical investment demand is officially projected to rise another 20% this year to a jaw-dropping 227 million ounces. Silver possesses a unique, powerful dual identity. It is historically a monetary metal that acts as the ultimate poor man's hedge against inflation, but it is also a critical, irreplaceable industrial commodity. The massive banking institutions and the paper markets on the COMEX might be able to suppress the spot price today based on high-frequency trading algorithms tracking the Federal Reserve, but they share one fatal flaw. You cannot print physical silver out of thin air. When major industrial manufacturers wake up and realize there is simply not enough physical metal above ground to meet their production needs, a physical short squeeze of epic biblical proportions becomes mathematically inevitable. At $76 an ounce, silver is not just a financial hedge against bad monetary policy. It is a coiled spring under immense, unsustainable pressure. Now, we must connect the final, most crucial dots to see the complete picture. Why is inflation remaining so agonizingly sticky? Why are interest rates staying elevated, punishing the average consumer? And why will this macroeconomic perfect storm ultimately propel gold and silver to heights that the average investor can barely comprehend? It all fundamentally comes down to the brutal intersection of geopolitics and energy. As we sit here today, the global geopolitical chessboard is quite literally on fire. We are watching extreme, heart-pounding uncertainty regarding the US-Iran peace negotiations. The Iranian Labor News Agency may report that diplomatic drafts are being finalized, but the reality on the blood-stained ground is starkly different. Iran remains entirely steadfast on maintaining its heavily enriched uranium stockpiles and is openly threatening a prolonged, devastating toll system over the Strait of Hormuz. Why does a body of water in the Middle East matter to your physical silver and gold investments sitting in a safe in your home? Because roughly 20% of the entire world's global oil consumption passes through that incredibly narrow, highly vulnerable choke point. When the Strait of Hormuz is threatened, global oil prices remain heavily elevated. When oil prices are elevated, shipping costs rise exponentially. Manufacturing costs skyrocket. Agricultural costs become unsustainable. This pain bleeds directly into the supply chain and violently pushes up the consumer price index. This dynamic is exactly why we saw those terrifying energy prices jump 17.9% year over year this past April. The Federal Reserve is currently trapped in a suffocating nightmare of their own making. They are backed into a corner with absolutely no graceful exit. If they pivot and drastically cut interest rates to save the fragile regional banking system and prop up the overvalued stock market, inflation will immediately explode back to 8%, 9%, or even 10%. The cost of living will destroy the middle class completely. However, if they keep interest rates high to aggressively fight the inflation caused by these massive geopolitical supply shocks, they risk triggering the greatest sovereign debt crisis in human history. The United States government is currently sitting on well over $35 trillion in national debt. The math is brutal and unforgiving. They simply cannot afford to pay the interest on their own debt at these elevated interest rates without borrowing more money just to pay the interest. This is a terrifying economic concept known as fiscal dominance. The sheer size of the national debt is so astronomically large that traditional monetary policy becomes entirely paralyzed. In this horrifying scenario, how do you protect your family? How do you shield the wealth you have spent your entire life building? You must step completely outside of the fiat currency system. When global bond yields rise to levels not seen since 2008, yes, the high-frequency algorithms blindly sell paper gold contracts. But the smart money, the sovereign wealth funds, the apex central banks, the billionaires quietly diversifying their portfolios, and the highly educated retail investors who actually understand macroeconomics, they use that artificial paper price drop to aggressively accumulate physical metal. They do this because they know that no matter what speeches the Federal Reserve Chairman gives, no matter what political party occupies the White House, they cannot print their way out of a physical commodity supply deficit. They cannot print peace in the Middle East. They cannot print thousands of barrels of oil. And they certainly cannot print physical gold and silver. I want to speak directly to you now on a profoundly human level because I know exactly how exhausting and frustrating navigating this manipulated market can be. When you spend hours doing the deep research, when you fundamentally understand the mechanics of a 762 million ounce silver deficit, when you actively watch Eastern central banks buying gold at the fastest pace in recorded history, it is absolutely agonizing to watch the price get violently smashed down by $10 or $20 in a single trading session, all because a bureaucrat in Washington stepped up to a podium and gave a slightly hawkish speech about the economy. It plays devastating tricks on your psychology. It makes you doubt your own thorough research. It creates fear, uncertainty, and crippling doubt. The system wants you to feel demoralized. The modern financial apparatus is specifically designed to shake the weak, emotional hands out of the market so that the institutions can buy your assets at a steep discount. You must realize that this extreme volatility is by design. High, stomach-churning volatility is simply the entry fee you must pay for ultimate, sovereign financial independence. Look closely at the broader historical context and what the major institutions are quietly forecasting behind closed doors. JP Morgan foresees gold reaching well over $6,000 per ounce by the end of this calendar year. Yardeni Research has published an incredibly aggressive $8,000 target by the year 2030, citing a massive policy-driven supercycle that cannot be stopped. For silver, Highly respected institutions like Investing Haven project a commodity supercycle pushing the price aggressively past the $100 mark. These are not just arbitrary, hopeful numbers drawn on a chart by retail day traders. These institutional forecasts are rooted in cold, hard, mathematical inevitabilities. When you hold a 1-ounce physical silver coin or a heavy gold bar in your hand, you are not holding an empty promise from a corrupt politician. You are not holding a fragile digital entry on a centralized banking ledger that can be frozen with a keystroke, inflated away to nothing, or deleted entirely if the grid goes down. You are holding immutable, physical, historical wealth. You are holding the only form of money that has successfully survived the collapse of entire empires, catastrophic hyperinflations, and devastating world wars. The extreme turbulence we are witnessing in 2026, the sudden 20% market corrections, the hawkish interest rate scares, the terrifying geopolitical standoffs in the Middle East, these are not reasons to panic and sell your assets back into rapidly depreciating fiat currency. For the educated, emotionally disciplined investor, these events are once-in-a-generation buying opportunities. If you sit on the sidelines waiting for the perfect, risk-free time to enter the market, if you wait for the mainstream nightly news to finally announce that the fiat system is broken and it is officially time to buy gold, you will be far too late. By the time the masses wake up, the premium on physical metals will be absolutely astronomical, and the physical supply will be completely gone. True wealth preservation is entirely about having the courage to take decisive action while the masses are still asleep and the media is still lying to them. We are currently living through an era of profound, irreversible consequence. The financial actions you take today, sitting in the middle of 2026, will permanently determine the financial trajectory of your bloodline for the next 3 decades. Do not let the temporary illusion of high interest rates fool you into trusting a dying fiat currency. High interest rates are merely a symptom of a deeply sick financial system, desperately trying to fight off the terminal infection of inflation. But the inflation we face is deeply structural. It is driven by actual resource scarcity, massive deglobalization, broken supply chains, and completely reckless government deficit spending that shows zero signs of slowing down. Gold, sitting at $4,500, is not the euphoric top of a bubble. It is the solid, foundational new floor in a deeply fractured, multipolar world. Silver, battling at $76, is not a struggling, outdated asset. It is a vital, irreplaceable strategic resource that is tightly coiling before the brutal reality of industrial demand completely shatters the artificial paper price suppression mechanisms. You must stay incredibly vigilant. You must stay highly educated. You must completely insulate yourself from the noise, and do not let the mainstream state-sponsored narrative manipulate you out of your physical position. Thank you so much for watching this deep, comprehensive dive into the markets. I pour my absolute heart and soul into doing this research and bringing you the unvarnished mathematical truth about these global markets, the exact information the financial elite would much rather keep entirely to themselves while they position their own portfolios. If you found real, actionable value in this video, please, I ask you to violently smash that like button right now. Share this video with your family, share it with your friends, share it with absolutely anyone you know who needs to understand what is truly happening to the purchasing power of their money. As I mentioned earlier, YouTube's algorithm does not favor this kind of hard-hitting, independent financial truth. So your direct support, your insightful comments down below, and your active engagement are the only ways we can break through the noise and wake more people up before it is too late. Make sure you subscribe to Aurex right now if you haven't already. I genuinely love all of my subscribers, and I am deeply, profoundly grateful for the intelligent, resilient community we are building together on this platform. Protect your wealth with absolute conviction, protect your family at all costs, and until next time, this is John A.G.,